I turned $5,000 into $6,185 in 6 months following Warren Buffett's strategy, but I almost gave up when I was down 9% and watching my friends make quick cash on meme stocks. What kept me going was one simple rule that Buffett uses, and most people completely ignore. So look, I'm not going to waste your time with theories or what some guru told you should work. I actually did this. Real money. Real stocks. 6 months of following Warren Buffett's exact playbook, and I documented everything. The wins, the losses, and that horrible moment in month 3 where I genuinely thought I'd made a huge mistake. By the end of this video, you're going to see the 3 specific stocks I bought and why I picked them. You're going to understand the one Warren Buffett metric that predicted which of my stocks would perform best. And you're going to learn the biggest psychological trap that almost made me sell everything at the worst possible time. So, let me take you back to July 2025. I'd been dabbling in stocks for about 3 years at that point. You know, the usual stuff. Buy some Tesla because everyone's talking about it. Sell it 2 weeks later because it dropped 4%. Check my portfolio like 15 times a day. I was basically gambling and calling it investing. Sound familiar? Then one night, I'm watching an interview with Warren Buffett, and he says something that hits different. He says most people treat the stock market like a casino, but it's actually a place where you buy pieces of real businesses. And I realized I couldn't name a single thing about what most of the companies I owned actually did. That's insane when you think about it. So I made a decision. I'm going to follow Warren Buffett's strategy exactly as he describes it for 6 months. No shortcuts, no getting distracted. Just pure value investing. And I set up some rules for myself. Rule number 1, I can only invest in businesses I actually understand. Rule number 2, I have to buy companies trading below their intrinsic value. Rule number 3, I'm buying to hold for at least 6 months, no matter what happens. And rule number 4, I'm starting with $5,000. Now you might be wondering why only $5,000. Well, here's the truth. Most people think Buffett's strategies only work if you're already rich. But I wanted to prove that the principles work, even if you're just a regular person with a regular amount of money to invest. So the first challenge was picking stocks. And this is where it gets interesting because Buffett's first rule is invest in what you know. But what do I actually know? I'm not an expert in pharmaceuticals. I don't understand oil and gas. So I had to really think about the businesses I interact with every day and actually understand how they make money. I ended up choosing 3 companies. Stock number 1 was Costco. Yeah, the warehouse store. Now I know what you're thinking, Costco. That's boring. And you're right. It is boring. But that's exactly what Buffett looks for. Here's why I picked it. I'm a Costco member. I go there probably twice a month, and I notice something. That place is always packed, and their business model is genius. They barely make any profit on the stuff they sell. Their real money comes from membership fees. In 2024, they had over 130 million members, paying between $60 and $120 per year. That's predictable recurring revenue. But here's the key part. I didn't just buy it because I like shopping there. I looked at the numbers. Their profit margins were solid at around 3%, which sounds low, but it's actually good for retail. Their return on equity was around 30%. And most importantly, they were trading at a price-to-earnings ratio of around 30. When I calculated their intrinsic value based on future cash flows, I estimated the stock was worth about 10% more than the current price. Stock number 2 was Visa, the credit card company. And this one was probably my favorite pick because the more I researched it, the more I realized how incredible their business model is. Visa doesn't lend money. They don't take on credit risk. They just process transactions and take a tiny cut every single time someone swipes a Visa card anywhere in the world. It's basically a toll booth on the global economy. The numbers on Visa were even better than Costco. We're talking about profit margins over 50%. Think about that. For every dollar of revenue, 50 cents is pure profit. Their return on equity was over 40%. And here's what really sold me. The trend toward cashless payments is only accelerating. They had a price-to-earnings ratio of around 20 when I bought in, and based on their growth rate, I felt like the intrinsic value was at least 15% higher than the market price. Stock number 3 was Procter Gamble. Yeah, the company that makes Tide detergent and Gillette razors. This was my safe, boring pick. The company that's going to exist and make money no matter what happens in the economy, because people still need to brush their teeth during a recession. What I loved about Procter & Gamble was the dividend. They've been paying dividends for over 100 years. They've increased their dividend for 67 consecutive years. When I bought the stock, it was yielding around 2.4%. Their PI ratio was around 24, and I calculated their intrinsic value to be about 8% above the market price. So there's my portfolio: Costco, Visa, and Procter & Gamble. I put 35% into Costco, 40% into Visa, because I was most confident about their future, and 25% into P&G. I placed all the orders on July 15th, 2025. And then came the hard part: doing nothing. Month 1 was actually pretty good. The market was having a decent run. My portfolio was up about 4%. I felt like a genius. But then month 2 happened, and this is where things got real. The market started getting choppy. There were concerns about inflation, and my portfolio started dropping. By the end of August, I was down 3% from where I started. Now, 3% doesn't sound like much, but I was down about $150. And psychologically, that hurt way more than it should have. But here's where it got worse. All my friends who were day trading and buying crypto were posting their wins on social media. One guy I know turned $500 into $2,000 on some AI stock. And there I was, sitting on my boring Costco shares, watching them slowly bleed red. The temptation to sell was intense. I started questioning everything. Maybe Buffett's strategy worked in the 1980s, but doesn't work anymore. Maybe value investing is dead. But then I remembered something Buffett said. He said the stock market is designed to transfer money from the impatient to the patient. So I made another rule for myself. I'm not allowed to check my portfolio more than once per week. Month 3 was brutal. September 2025 was rough for the markets, and my portfolio hit its low point. I was down 8.7%. That's $435 in losses from my original $5,000. And this is what I learned: the most important lesson of the entire experiment. The stock prices were down, but the businesses hadn't changed. Costco was still packed every time I went there. Visa was still processing billions of transactions. The market was basically having a mood swing, but the fundamental value of these companies was the same, or even better. Costco had actually reported strong earnings that month. Their membership renewal rate was over 90%. But the stock price dropped anyway because the overall market was in a bad mood. This is what Buffett means when he says, price is what you pay, but value is what you get. The price of my stocks had gone down, but the value hadn't changed. And this is the key insight that most people miss. When you own stocks, you don't own pieces of paper that go up and down randomly. You own tiny pieces of actual businesses. So I did something that felt completely wrong at the time. Boat more. I had been setting aside money each month, and in September I added another $500 to my portfolio. I put it all into Visa because it had dropped the most. This is what Buffett calls being greedy when others are fearful. Now, if you're getting value from this video, do me a favor and hit that subscribe button, because I've got more experiments like this coming. So month 4, October rolls around, and something interesting started happening. The market began to recover, and my portfolio suddenly started climbing. By the end of October, I was only down 2%. The momentum was shifting. Procter & Gamble had paid me a dividend in October. It wasn't huge, about $28, but I set it to automatically. This might seem like nothing, but over time, this is how wealth actually builds. Buffett calls this the snowball effect. Month 5, November, was when things really started clicking. The market had fully recovered from the September dip. My portfolio was now up 6% from where I started. That's $300 in gains. But more importantly, I had stopped caring about the daily price movements. I wasn't checking my app obsessively. I was just letting the businesses do their thing. Costco announced they were raising their membership fees for the first time in years, from $60 to $60. Now, you might think that's bad, but actually it's genius. They have such strong customer loyalty that over 90% of people keep their memberships even when prices go up. And that $5 increase translates to hundreds of millions in additional revenue. By the end of November, I was up 11%. That's $550 in gains. But here's what surprised me most. I felt calm. There was no anxiety about missing out on the next hot stock, because I knew my companies were solid businesses. Month 6, December, was the final stretch. And honestly, it was kind of anticlimactic in the best way possible. The market had a decent month. My portfolio kept grinding higher. There was no dramatic moment. It was just steady, consistent growth. By December 31st, 2025, my portfolio's worth $6,185. That's a gain of $1,185 on my $5,000 investment, a return of 23.7% in 6 months. Now, let me put that in perspective. The S&P 500 returned about 12% during that same time period, so I beat the market by almost double. But here's what's even more important than the numbers. I learned that investing isn't about being smart or predicting the future. It's about having a system and sticking to it, even when it's uncomfortable. The biggest lesson from this entire experiment is that the hard part of investing isn't finding good companies. The hard part is the psychology. It's sitting there when you're down 9% and not panicking. It's ignoring your friend who made a quick profit on some random stock. It's being patient when every instinct is telling you to do something. If I had sold in September when I was down almost 9%, I would have locked in a loss of $435. Instead, I held on and ended up with a gain of $1,185. That's a difference of $1,620 just because I was patient. The second big lesson is about understanding what you own. I can't tell you how many times during this experiment I felt calm just because I knew why I owned each stock. When Costco dropped, I didn't panic because I knew their business model was solid. That knowledge is what gave me the confidence to hold through the rough patches. The third lesson is about margin of safety. Every single stock I bought was trading below what I calculated to be its intrinsic value. That cushion is what protected me when the market got choppy. Now let me tell you what didn't work. My biggest mistake was not buying more when prices were low. I added $500 in September, but I should have been more aggressive. When quality businesses go on sale, that's the time to load up. I was too cautious because I was scared. Another thing I'd change is my position sizing. I put 40% in Visa, and while it worked out, that's probably too concentrated. For someone at my level, I probably should have spread the money more evenly. But overall, this experiment exceeded my expectations. Not just in terms of returns, but in terms of what I learned. I proved that Warren Buffett's strategy works even with a small amount of money. I proved that patience beats activity. And I proved that understanding businesses is more important than trying to time the market. So let's recap the key points. Number 1. Invest in businesses you actually understand. Don't buy a stock just because someone on the internet said it's going to moon. Number 2. Buy with a margin of safety. Wait for the market to give you a discount on quality companies. Number 3. Be patient, especially when it's hard. The times when you most want to sell are usually the times you should be buying more. Number 4. Focus on the business, not the stock price. And number 5, ignore the noise and the hype. Now, I need to say this. Nothing in this video is financial advice. I'm not a financial advisor. I'm just sharing my experience. Every investment carries risk, including the risk of losing money. What worked for me might not work for you. Always do your own research and consider talking to a qualified financial professional before making investment decisions. Have you ever tried following Warren Buffett's strategy? Drop a comment and let me know. Thanks for watching, and I'll see you in the next one.